Carl, we saw the statement early this morning. Not a whole lot of news therein. The open question was, what is she going to say, if anything, about the prospects of stimulus under a Donald Trump presidency? Or what are the congressmen who are asking her questions going to say about it? What did we hear today?
Right. So she didn't mention much about that in her prepared testimony. Probably the more interesting part of the whole episode was the Q&A. And she basically was saying, well, we needed stimulus earlier on in the economic cycle when the unemployment rate was 8%. Now that it's down to roughly 5%, it's much less critical. So she warned that adding fiscal stimulus to an economy that's very close to full employment could actually generate an undesired pickup in inflation.
Hang on a second, though, Carl. Okay, so she does anticipate, quote, net expansion of fiscal policy. So they are expecting. Right. But haven't they been begging fiscal policymakers for years to actually add some fiscal stimulus?
Yes, that's the irony. But her point was basically we needed it more a year, 2 years, 5 years ago than we need it right now. So now it's kind of just icing on the cake, really, for the economy. That being said, she also was bemoaning low productivity growth, and fiscal stimulus and infrastructure spending could actually help to move the needle on low productivity.
Kevin, Karen, we saw the markets react to the prospects of this economic stimulus earlier in the week. What did you hear today that led you to believe that that was coming? And then when you think about it, what's the timetable for stimulus like that coming to fruition?
There's a much greater likelihood of stimulus, that's clear, but there's a lot of details that aren't there yet, and that's why you didn't hear very much from Janet Yellen today. There's a lot of waiting now to see who the players are going to be and what actually is going to be the agenda. And don't forget, there was another aspect of this. It's not just the fiscal deficit, but it's also the trade deficit that is going to be something that's going to have to be focused on. And you really can't answer one question without the other. So if the fiscal deficit is expanded while the trade deficit's coming in, that means one thing. If the trade agenda slips and it just becomes a more Keynesian-style fiscal plan, then the expectation would be that you'd have a pickup in growth and inflation.
So, Kevin, what do you do then? You were long risk going into the election, and so everything panned out very nicely, but you're rethinking positions now and wondering what's next. Yeah,
so what we're thinking about coming is that there was this initial reaction, you had a big jump up in bond yields. There's going to be a period of reconciliation, though, where we're going to have to see exactly how much that has already been priced in is going to stick and how much is going to get backed out as reality sets in. So for us, when we came into the middle part of the year, we saw a big pickup in fundamental conditions. We saw the 10-year Treasury yield very low, depressed because of Brexit. That led us to be overweight equities, overweight U.S. equities, underweight Treasuries, overweight high yield in our asset allocation portfolios. But now we're at a point where some of that may be looking to reverse. We haven't seen a downtick in fundamentals yet, but that's going to be something that we're going to be looking for.
Carl, what did we learn about Fed Chair Janet Yellen's awareness of her position in this new administration? She has been the target of a lot of hot political rhetoric. I wonder about the degree to which that's been echoing through the marble halls of the Eccles building. Is she acknowledging that that's going to change? Her role is going to change. We hear talk of rules-based approach to the Fed.
Well, she was featured in campaign commercials, yes, even to that degree. So the important thing, I believe, was that she signaled she fully intends to serve out her term, which will last until early 2018. And continuity from the central bank is very critical at a point of transition in terms of fiscal authorities and whatnot. There was not much guidance on whether she would consider an additional term beyond that, but the fact that she's serving out her term is important. And all along we've talked about central bank independence, and if suddenly the Fed chair is stepping down because they don't like the political situation in Washington, that certainly raises questions about their political independence. So she put that to bed.
So, Kevin, what is the most important question that you guys are focused on right now, and where does the equity and bond market go in the next 6 months?
The question is whether or not the lift that we've gotten in data, which we've seen more recently in earnings and a turnaround in S&P earnings for the quarter, whether or not that lift continues. When we came through 2015 into 2016, we were getting slower and slower and slower with lots of negative earnings growth. That looked to us like the potential for a recession. We're happy to see that turnaround. If that continues and this little pop in enthusiasm carries over into the new year, that's going to be a major catalyst for how we set up for the new year.